What we're going to do now is we're going to take the principles of activity-based costing and apply them to customer value, to customer profitability analysis. What do we mean? We have these customers here. They are hungry for your resources. What do we mean? They are hungry for your sales, administration, and finance resources. Now here's a big question for you, and you need to know this for your job application. Could you do a profit and loss statement? What are you going to do? You're going to have revenue less cost of goods sold, gross profit less operating expenses equals net profit. There's your profit and loss, right? Do you all know that? You better know that for your job interview. Now, management accounting, most of us focus on this cost of goods sold area. That is, things that go into the pricing of a product, things that go into determining the profitability of the product, the margin of a product. But very few of us look at these operating expenses. What are they? Selling, admin, finance. And they are incurred in the process of selling to customers. They are incurred in the process of administering customers, following up on customers, making sure they pay on time, okay, dealing with bad debts, dealing with expedited orders, and not all customers force you to incur these expenses in the same way. So is there some way that we can allocate these costs to customers and then have a better decision? Remember, this course is all about decision making. So what is the economic decision here? Really, there are 4 of them, and we're going to cover that shortly. So here's what we want to do. There's the learning objectives that we're going to cover, just in terms of what we call it, in terms of administration of the exam. We're not going to have time to cover sales profitability analysis. Okay, today we'll get up to learning objective 3 and 4. Notice cost allocation comes halfway through the chapter, but we're going to consider it first today. Okay, in edition 15, this occurs halfway through. In edition 14, this cost allocation basics occurs very early on. So it's a different schedule here. But we're definitely going to focus on customer linkages. So let's get into this good stuff. And again, we've got our hungry customer. But before we do that, we need to understand what is the purpose of cost allocation. It is about making different decisions. It is about supporting different decisions that need to be made in the organisation. Supporting different decisions. Here are the different decisions, or the different purposes. To provide information for economic decisions. To motivate managers and other employees. To justify costs or compute reimbursement. To measure income and assets. Interesting. That last one is more financial accounting. Ugh. Who likes that? Put your hand up. No, I didn't think so. All right, it doesn't add value, not much anyway, all right, except for international accounting. Okay, all right, so the first 3, very important. Information for economic decisions. To motivate managers, this is decision facilitating, decision influencing, right? You know that. And here, justify costs. So here's your job. You have this criteria for cost allocation: cause and effect, benefits received, fairness, and ability to bear. Question. Each of these are a different criteria for why we may allocate costs. So here are some examples of that criteria. What I want you to do in groups of 2 is to try and match these examples onto these 4 criteria. And let me explain these 4 criteria briefly. Cause and effect is your pure, this is your pure argument that scientific evidence that something causes something else to happen, okay? The moon comes up, it changes the tides, all right? There's cause and effect, okay? Cause and effect is something that is not necessarily human. It can be, but also it can be more a mechanistic association, okay? Cause and effect could be human in terms of I leave you satisfied as a customer and then you come back and buy from me again in the following month. I leave you dissatisfied and then you come back and don't buy from me, okay? All right, that's cause and effect at a human level, but there's a mechanistic cause and effect too, okay? For example, if I drive the car faster to travel from A to B, I will naturally use more petrol, okay, because the motor may not run as efficient if I drive more aggressively. You with me? Okay, so cause and effect, okay? There's the mechanistic cause and effect, but also we could say there's some psychological cause and effect. The way in which you treat someone that causes them to behave in a certain way, okay? Benefits received. Benefits received is another way of allocating costs. And it's this may be in terms of, maybe there's no cause and effect, but you may want to try and allocate according to ability to bear or fairness and equity. This one is kind of like a grey area because you can say, oh, fairness and equity, benefits received is one way of being fair. Oh, someone receives more benefits, one department, here's one department here, you are selling to retail, here's one department here, you're selling to commercial. Commercial, you're making so much more profits because you can sell at a higher margin, you've got more volume, but you both use up this same lecture space, administration space. I'm going to charge you equally 50% for the rent of this office space. And then the retail, my retail friends, this half, that's not fair. You know, we don't get the high margin opportunities that the other half get. You know, why do we have to bear half of this $10,000 of rent that we're paying per month? Well, you're using half the space, that's fair, isn't it? Okay, so if I allocate the rental on basis of space, that's kind of like cause and effect because you're occupying half the space, you're causing half of that rental to be incurred, right? Because if you're not here, maybe I just have half the space and I only have to pay $5,000 per month. You see the cause and effect? You could argue, no benefits received. You say, no, the commercial division should be getting more of that rental allocation. Why? Because they get more benefits. They're getting more margin, they're making more sales, they're making more commission, all right? Or fairness and equity is it's the same argument. It's not fair that we use half the space, but we don't have the opportunities to earn as much commission as the other side. You with me? So that's kind of like a fairness equity. Benefits received and fairness equity, in some ways, they're similar in that way. Ability to bear, what do we mean by that? Well, it may be in terms of how big one division is versus another division, even though they're using the same amount of space. Okay? This division has much more ability to bear, much more ability to pay for that rental. So, the first thing you need to take away here is that they're all related. Especially the last three, benefits received, fairness and equity, ability to bear. fairness and ability to bear, they're kind of similar, right? Benefits received is kind of similar to cause and effect in some ways. So in some ways you've got 1, 2, 3, 4, but really there's two groups, this group and this group here. So what I want you to do now that I probably haven't explained it very well what those four mean, but here's your chance now to think about which of these examples fit under those four categories. These are principles of cost allocation. Here's the reason why you need to know this. Here's the reason why. It goes beyond customer profitability analysis. Next week we're going to look at overhead cost allocation or service department cost allocation. You probably think, boring. Yeah, but actually in organisations it means a lot. The way you allocate costs means a big deal for particular decisions that are made. It's a big deal for how you motivate people. If you allocate costs in the wrong way, you may not motivate people. People may end up leaving. So you need to be aware of why are we allocating costs in a certain way. This university allocates costs. On average, universities incur the fees you paid to the university, right? You all paid some money, right? Yeah. Okay. Only half of that goes to people like me for teaching salaries and all of that. Did you know that? Right? Should be more, right? yeah, should be more. I agree. All right. Half of it goes into administration. Did you know that? Over 50%. I can't believe it. How inefficient is that? Okay, well, there's many other reasons for that. All right, so universities are big. Because they get so much money, they have opportunities to allocate costs because they spend a lot of money. There's cleaning to be done. There's electricity to be done. There's electricity to be allocated. This lecture theatre costs money. It's part of the depreciation each year. There are costs there. How do we allocate it to this program? Do we allocate on an hour basis? I don't know. What about the time between 10 o'clock and 6 a.m. in the morning? It's not being used. But we still have to find costs. We still need to allocate costs somewhere, right? All right. So there's a lot of, when you get into cost allocation, it can get very, very detailed. Like it affects how corporate organisations work. The whole idea of how they allocate costs. It's a big deal. So these are the basic principles that it boils down to. What I want you to do now, here are some examples. Here are some examples of cost allocation. In groups of two, I don't want any lone rangers, okay? What do you mean by lone ranger? What do I mean by lone ranger? I want you to work with someone next to you. Okay? If you're on your own, sit next to someone, please. Okay? Now, and so I want you to find examples. What you have to do is, for each of these examples, is it 1, 2, 3, or 4? In terms of 1, 2, 3, or 4. Okay? Okay, let me put you out of your misery. We have cause and effect. Examples of cause and effect. Variables are identified that cause resources to consume. Most credible to operating managers. What do we mean by that? Operating managers. In other words, managers who are in charge of operations. So setups cause setup time to occur. More setups cause slowdown in production, disruptions in production. You with me? Okay. Setups may cause more errors because you are starting and stopping more often. Okay. I'll give you an example in a minute. Benefits received. Beneficiaries of outputs of the cost object are charged with costs in proportion to the benefits received. Fairness and equity, the basis for establishing a price satisfactory to the government and supplies. Ability to bear costs are allocated in proportion to cost objects' ability to bear them. Generally, larger and more profitable objects receive proportionally more of the allocated costs. I want you to think about this. This is kind of like a theory of cost allocation. All right? So you can choose that as the basis depending on your objective. If your objective is to provide information for economic decisions, which do you think the best basis will be? What's the best basis for the first objective? Cause and effect, yeah. All right. To motivate managers and other employees. Possibly benefits received and? Maybe, and possibly fairness, right? Can you notice that you may deliberately move away from cause and effect in order to achieve that second objective. You with me? Okay. So step one, this is what you need to do with the decision making. Step one, what is the decision? What is the decision? What is your objective? Okay? Is the objective to have a more accurate allocation, so you make a better pricing decision, or find out better customer profitability analysis? Or is your objective to achieve more accountability? Your objective is to achieve a greater motivation of the people that are using that resource. You see, two different things. All right? What is your objective? Number two, what is the best basis of allocation? Okay? So, it's possible that we can have something like this. Let me keep it very simple. All right? I'll try and keep it simple for you. You have your objective and you have the basis for allocation. This could be cause and effect, and the other one could be more fairness. All right? Or ability to bear, or the other one, okay? Here, the objective may be is for accurate pricing. Here may be to motivation, accountability. Awareness, just build awareness. In some ways, this is going to match with that objective, and this is going to match more with that objective often. You with me here? Of course, this one can also help here. Of course, this one, may spill over, all right? But I'm just saying the dominant purpose of this principle is going to support accurate information, okay? I don't care whether you are happy or sad, motivated, unmotivated. I just want to know, does this product make me money when I sell it at this price? You with me? All right? It's very clinical. It's non-human. You with me? All right? At the very essence of this principle. Whereas here, you're trying to just balance this clinical approach with the emotion, the psychology, the energy that you want to maintain and build up in the organisation. Are you with me? Okay. All right. So I think this is one way of trying to bring this page, try to merge it with the 1, 2, 3, 4 here. But rather than having 4 down here and 4 across, just try and just don't overcomplicate it, all right? Just try and keep it simple, all right? Okay, very clinical, but a bit more, what? Emotion, friendly, you know, a bit more humane, right? Okay, here, clinical, you just want the facts here. But here, well, okay, we're focusing on getting teamwork going. We're focusing on having a happy culture. We just don't want people to leave if we make it too clinical and too economic. You with me here? People didn't join this organisation to just be an economic machine, okay? It's not the Wall Street trading floor, okay? I joined this organisation because it's a family. It's a great place to work. You with me here? All right? So you've got to think about what is the objective before you okay, is this principle a good one or is this one a good one? All right? Of course, if you want to delve deeper and think about, okay, what about the other two and then what about the other two over here? Yeah, you can do that, but just, I think take away that tonight is quite sufficient. All right, so there we go. That's our first essence for the night. Next, value chain analysis. This is something I just want to spend a very short time on. And it's as follows. If you study basic management accounting, the focus is on production. It's on the product. It's on what is a profitable product? What is the margin of the product? What price should we sell it at? Remember the example we did 2 weeks ago? Competitor come along and offered $10 cheaper. And then after we did activity-based costing, we realised that, well, the costs allocated to that product could be $11 less. So maybe we can compete. We don't have to give up. You remember that? Remember the light globe? All right? Remember that? So that was totally focused on getting more accurate allocation of what is going on in producing a product. But very little of the costs associated with marketing, distribution, all of these were taken into account. What we're trying to do with customer profitability analysis is to bring in all of these costs, more of these costs. See, some customers take up more of this than others. Some customers take up more of this than others. Some customers do this, okay? Others don't. They just get on with life. You with me here? All right, so this is what we're on about tonight. Any questions at the moment? Not yet? Okay, so just keep that in mind. Strategic management accounting, we really focus on long term. Strategy is another word for long term. Okay, and so we've got these decisions. Whereas at basic management accounting, we'll focus on short-term pricing decisions. Short-term decisions for external reporting. Okay, for inventory valuation, it has to go into the balance sheet. It has to go into the income statement. Okay, that was still important. Okay, so here's the thing next thing I want you to take away. And that is, what if, how many of you have had a job interview yet? Done job interviews so far? Hands up. Okay, you're in a job interview in the next 6 months, and I hope you all get some interviews under your belt. A couple of dozen. And you'll get better, many of them. Don't expect the first time around. You can do it. All right? But what if they ask you, oh, can you tell us what a profit and loss statement looks like? How many of you could do something like this? All right? Because that is what activity-based costing is, basically capturing these costs and finding a more accurate way of tracking the resources consumed by the different products that you make. But activity-based costing did not talk about selling, administration, financing, which is about customer profitability analysis, because different customers use different selling, administration, finance expenses. They buy your product. They purchase a product here, but some customers in the purchasing process take more convincing. Some customers they want a discount. Some customers say, we're not going to pay you for 3 months, like what Apple does to its suppliers in China. And suppliers say, okay, that's fine. But you go to those suppliers and they'll say, give me the money. Show me the money, all right? Because you are a small potato, all right? Apple, the big potato, can command, we'll pay you in 3 months' time. And that's okay because suppliers know they will get paid. Apple's the largest company in the world. It wouldn't default, okay? All right, so not all customers are the same. Here, not all products are the same in the consumption of resources. Here, not all customers are the same in the consumption of resources. And that's the big thing you want to take away. You all need to know this basic profit and loss statement. You need to know that. All right? Here's our friendly customer. No, they're not friendly. They are resource consuming. They are taking your resources, and some more than others. Seriously. You talk to a lot of managers, you talk to a lot of businesses. They've had it up to here with customers. If only there were no customers, I could still make sales without the hassle of the headaches that some customers give me. Of course, I wouldn't say that publicly, but customers give businesses headaches. All right? They are eating your resources, eating it alive. So we're going to look at revenue analysis, then we have a quick look at cost analysis. Then we go back and see what it means. My friend from Malaysia. My friend Honson used to work for Apple Tree. Interesting story about that. This is a company in Malaysia, and they make the Instant Dick dictionaries, electronic dictionaries. Okay, so Apple tried to sue them because they're using a name that's very close to Apple. Pretty close, isn't it? Apple Tree, right? But the Malaysian government said, oh, go jump in the lake, Apple. This is Malaysia here. All right, so there was no problem. All right, okay. So yes, depends which country you're in, right? Okay, customer profitability analysis focus on selling, general, administration costs. That's exactly what I just told you in the previous slide. If you're in marketing, they'll talk about, they've got lots of customers. Over here, they're champions. They give you lots of money and they give you few headaches. But there's customers over here that are very demanding. Look, they're eating up your, ouch, they're eating up your resources, just like that. Eating all the time. Always ringing up, always complaining. Oh, have you got this? Can you help with this? Always. All right? And you're sick of them. You just want to charge them an extra fee just to say that they get angry and say, I'll leave if you charge that fee. Okay, you go. We want you to leave, all right? Seriously, every businesses have those customers, all right? Down here, all right? So customer profitability analysis is about differentiating who are the good ones, who are the bad ones. You need to be able to calculate that. That's valuable. It's not just cost accounting. This is strategic. All right? This is totally strategic. I can show you a YouTube. It might work. This is true. This is an SAP YouTube clip.
Because each customer is unique. Because their needs and lifestyle are changing fast. Because in a few clicks, they can compare your prices to those of your competitors. Your pricing policy has to become highly dynamic and highly configurable. It is no longer a question of selling a product at a fixed price, but a range of customized services for a given client. thus a personalized price. Well, almost. In order to remain competitive in the eyes of customers, your offers and your pricing need to suit their profiles.
Wow, that means you just cannot have one offer, one price fits all. Every customer is different, all right? Basically what they're saying is they're using different amounts of your resources. Interesting.
And their evolutions.
What we learn later is that when we identify the high profitable customers, it's likely that they're the ones that buy the bundles. They're the ones that you may strategically try and sell new products because they have bought high value products from you in the past. They're more likely to buy in the future. Maybe you want to avoid the customers that give you trouble with new products because maybe they complain more, all right? Maybe they'll return the product sooner. Maybe they will complain in the social media, all right? Maybe you don't want to touch those customers. You want to know who they are so you can avoid them, okay? Especially when you're trying out new products, okay? You may want to give them to your more profitable customers that don't give you much trouble and expect problems with new innovations, new functionality, things like that. All right, so this is an advert from SAP that provides a software that enables organizations to do customer profitability analysis. Interesting, huh? All right, so let's get on with our PowerPoint, and I don't mean to give you too little airtime on the YouTube. We'll come back to another one in a minute. Now it's time for you to do some work in groups of 2 or 3. Okay, no lone rangers. I want you to think about the following. Okay? The following are 4 big decisions that management are interested in. Strategic customer acquisitions, continuous improvement, setting prices based on cost to serve, or value-added service management. What I want you to do, 1, 2, 3, 4, how do they fit? As if these are examples of one of those 4, I want you now to match. You think you can do that? Okay, go. Do you know what you have to do? Match. These are concerns of managers, but really they come under 4 general categories in how managers can deal with customers. What are those 4 categories? They are strategic customer acquisition, continuous improvement, setting prices based on cost to serve, value-added service management. Remember, what are we doing? Listen up, everyone. Let me remind you what this course is about. What is driving this course? Okay. Can I have your attention for a moment? This is very... Hello? Hi? I need your attention. Okay? I need your attention, not your phone. All right? So, I want your attention. That this course, at the end of the day, is all about decision making. It's all about making information for making better decisions. That's all. Let's not make it more complicated than that. That's all. All right? Full stop. That's all. What you have here are 4 different types of decisions. You with me? So the exercise you just did is I keep bringing you back to the key. What decisions does this information help you with? See, what What decisions does following this principle or following this principle help you with? You with me? This type of decision or this type of decision? Class, you with me here, right? I always got to try and bring you back to a decision, all right? You have to you have to demand that. When you're presenting next week, let me ask, all right, bring up, how's the exercise that you're presenting next week? What is the relevant decision being made? What is the information for the decision? Talk about that, okay? So here are 4 decisions, and here are some of the concerns under each of these decisions. Okay? So this is why you're doing the exercise you're doing, because I want to remind you that it's about information for decision making. Okay? You are not pricing a product this week. Okay? 2 weeks, okay? In the second week you are pricing a product. Okay? Now you're not pricing a product. Now you might be thinking about how are we going to acquire more customers. Okay, that's a different decision than pricing a product, you see. All right, continuous improvement. All right, that's not pricing a product. That's about how can we do things better with less money. Okay, you with me? All right, setting prices based on the cost to serve. Now that may be related to pricing a product or pricing a service. You with me here? All right, or value-added service management. How do we structure the extra service we provide? You see, they're decisions. Okay, this is not theory. These are clear decisions. This is in Moodle, so I don't want you to spin out in terms of missing out on the correct answer. Okay, right. What do you think? Class, what do you think? Does this make sense to you? All right, okay. So now, tonight already, I've given you ideas and related you back to decisions. All right? So let me tell you about a decision that has been made in the last month or so. This is real. Okay? How many of you have heard of factor? F-A-C-T-A, factor. Factor. This is a new rule, new laws that the Hong Kong government has entered into with the OECD, where the US government, the IRD, Internal Revenue Department of the US, can seek information from many of the OECD countries, information about the names and the amounts of deposits and transactions of any US citizen. And the Hong Kong government last year signed an agreement to give information under this new law. We're going to do more about that in international accounting, but how does it affect you? What does that mean? So if you're HSBC, you're Hang Seng, you're DBS, you're Citibank, you're in Hong Kong, every year you have to give a report to the US government of large transactions by US citizens that are in your customer list. Large transactions, large account holdings, anything unusual. You have to do a report. How many US citizen customers do you have? How much money is there? You have to do that for your US citizen customers. But interestingly, and luckily, I'm not a US citizen, I'm an Australian citizen. So the bank doesn't have to do it for me. So suddenly, your HSBC, you have US citizen customers, you have non-US citizen customers. Suddenly overnight, which customer is now less profitable? Hello? Yeah, the US citizen. So what are many banks in Hong Kong doing? What have they decided in the last... What decision have the banks in Hong Kong made in the last few months? To do what? Have they decided? To no longer accept US customers in new accounts. To no longer accept US customers, US citizens, in setting up company accounts. Wow. Hong Kong and Singapore. This is real. Check it out. Okay? Why are they doing that? Simple. That type of customer is no longer as profitable. It's a burden. It's an administrative burden. Wow. Look at this. I don't open US accounts, period, said head of private banking at Singapore-based DBS. Large bank out of Singapore. Clear. All right? That's decision being made because that type of customer is not as profitable. It's burdensome. It's an administrative burden. Okay? So, this is real. This is not textbook stuff. So, try tomorrow. Ring up a bank and say you're a US citizen and ask them if you can open up a bank account. Oh, golly, I'd love to see what the response was. Okay, all right. You want to try. Bank of Singapore, a private overseas banking corp, ranked strongest in the world, okay? Turned around millions of dollars for Americans because it doesn't want to deal with regulatory hassle. Regulatory hassle, in other words, just administration, okay? Where was that in the profit and loss? On selling, admin, and finance. In the admin, you with me here? All right? Economic decision being made right in front of your eyes in Hong Kong and Singapore in the last 6 weeks. Exciting. This is exciting stuff. This is real. Okay? So, check that out. Oh, do you want to know something else that's real? When you ring up a bank and ask for some help, maybe you have a credit card. Maybe every year they charge you a fee. And maybe every year you ring up and say, you charge me a fee. I want you to take the fee off my card. And what do they normally do? They do take it off. Most cases. All right? Depending if you are a red, amber, or green customer. What does that mean? Well, some banks and institutions have a stop signal that flashes up on the computer beside your name to give an indication to the operator about whether they are allowed to break policy rules in serving you. Did you know that? Wow. Okay. AIA, this is 2008, not a good time. These are angry customers hoping to get their money back in Singapore. All right. Customer Profitability Insurance Company. This is what we're trying to do. If we were to batch all of the customers together, we're going to find 20% of the customers may provide 80% of the revenues. Many of the customers may break even. Some will cost you money. So let's think about decisions. What can we make? If we know our customer is of this profile, what decisions could we make? What could we do with this group? What could we do? It's more strategic customer acquisition. We want more of these customers. Maybe we want to find out more about them, what their needs are, how can we serve them better, how can we stop them leaving, right? We don't want them to leave because they're profitable, right? You with me here, all right? What can we do with these customers here? Do what the banks in Hong Kong did 10 years ago. They slapped fees on all customers in Hong Kong that had bank accounts with balances below, I think, 1,000 Hong Kong dollars. And there was an uproar. No, you can't do that. We're going to take our money and close our account. And the bank's thinking, yeah, do that, please. All right? Because when you do, we're going to make more money because we're going to lose the unprofitable customers. Right? So this is real, okay? You can make real decisions when you know more about your customer profile, right? All right? So the whole purpose, and I haven't done any calculations yet, the whole purpose of chapter 14 is to show you how to calculate this customer profile. That's what you have to do. All right? That's your job in the next week. That's what you have to learn. Because what I've spent tonight telling you is why it's valuable to you for decision making to know that some customers are here and some are here, but which ones are which. If you know that, you can make better decisions, right? Now you know the why. What you need to do during the week is open up chapter 14, all right? That's the chapter that comes after 13, right? Okay, open it up, all right? I'm not sure if you opened it up recently, but have a look into it. It's quite interesting reading, and it will show you how to do the calculation, all right? Okay, and it will show you an example. To help you with this, I've created 2 YouTube videos. One is of an example that's not in the textbook, and I've just spent the afternoon recording another video that takes you through the example that's in chapter 14. Okay, so that's what we're doing.